Hi guys, we are the Group 6 and welcome to our report. Our topic for this discussion is measuring money supply. These are the subtopics that we will discuss later. We have the categories of broad money, the concept of money multiplier, effect of interest rates in money supply, effect of central banks' money operations in money supply, effect of increasing and decreasing reserves in money supply. Let us define first money supply. It is the total amount of money in circulation or existence in a country. Ito raw ang kabuuang pera sa isang ekonomiya na nagsisirculate sa isang bansa. My name is Lyka Duaqui, your reporter for the categories of broad money. Broad money is a category for measuring the amount of money circulating in an economy. It is defined as the most inclusive method of calculating a given country's money supply and includes narrow money along with other assets that can be easily converted into cash. Federal Reserve is a bank regulator and is responsible for monetary policy and defines money according to its liquidity. We have measures of money which are M1, M2, and M3 or M4. The letter M before the number means measure. Ito yung ginagamit sa pag-measure sa isang pera kung gaano ba ito ka-liquid. First, we have the M1 or measure 1, also called narrow money and includes coins and notes that are in inclusion and other money equivalents that can be converted easily to cash. These are the money equivalents na sobrang dali i-convert into cash. Example nito ay ang mga demand deposits and checking accounts which are commonly used exchange medium at yung madalas natin ginagamit ay debit card at ATMs na sobrang dali ma-convert into cash. Second, we have the M2 or the measure 2. It is a calculation of the money supply that includes all elements of M1 as well as near money. Near money ito yung mas commonly na tinatawag sa M2. Example ng near money ay ang mga savings deposits, certificate of deposits, foreign currency, money market accounts, marketable securities, and treasury bills or what we call T-bills. These near money are also highly liquid assets which are not cash but can easily be converted into cash. Si Federal Reserve System ay responsible para i-track ang amount ng Measure 1 at Measure 2 para mag-prepare ng weekly release of information about the money supply. And meron lang din po akong konting trivia. Is credit card considered a near money? And the answer is no. Credit card is not considered as near money kahit na nagagamit siya as substitute sa cash for purchases dahil ang credit card ay nagpo-provide ng liability or debt and not cash. We also have Measure 3 or Measure 4. This includes all the items in Measure 2 plus repurchase agreements, money market fund shares, money market paper, and debt securities issued with a maturity of fewer than 2 years. These measures of money are the categories of broad money, which are least liquid, meaning not easily converted into cash. M3 includes M2 money as well as large time deposits, institutional money market funds, short-term repurchase agreements, and larger liquid funds. Ito yung mga long-term basis na mga pera bago sila ma-convert into cash. That's why they are called least liquid. Ang M4 naman are those cash outside banks such as in circulation with the public and non-bank firms. Dahil nakapaloob sa M3 si M2 at si M2 naman ay nakapaloob sa M1, it means broad money includes notes and coins but also saving accounts and deposits in a savings account. It also includes treasury bills and gifts. These financial securities are seen as near money because they are more liquid than cash and instant savings account. At dahil si broad money ay ang concept sa pag-measure ng total amounts of money supply na nagsisirculate sa economy ng isang bansa, siya din ang nagbibigay idea at nagbibigay comprehension para sa pag-calculate ng money supply na meron ng isang bansa. Benefits and the advantage of the broad money is it lets the policymakers get a better understanding of future inflationary trends na kung magkano ba ang pwedeng ma-increase sa mga goods and services sa isang economy. It is really important for us, lalo na sa mga economist or policymaker, na malaman ang movement ng broad money or ng money supply. Dahil dito sila kumukuha ng basis to calculate the inflation and to set the interest rates for the economy. It is also the basis to make a solution or an action para makontrol ang sobrang pag-accelerate ng economy o sa sobrang pagbagal ng paggalaw ng economy natin.
Have you ever wondered what happens to the money which you deposit in banks? Does the money simply remain there? And have you also heard the economic term called money multiplier? Well, Samantha, Guiao, and I will cover that topic so that you would understand. But first, what is the word multiplier? Multiplier is simply a factor that amplifies or increases the base value of something else. This shows a sum injected into an economy travels and generate more output. It is simply refers to the increases of value in money. In addition to that, multiplier theory were created by British economist John Maynard Keynes dahil naniniwala siya that any injections of government spending is nagkikreate ito ng pagtaas ng overall income para sa lahat since extra spending would carry through the economy. Next to that is the money multiplier. Money multiplier is the amount of money that banks generates with each dollar of reserves. When we say money multiplier, this relates to fractional reserve banking and how banks create money in the economy in the form of credit creation. In here, money are being deposited and loaned out. So, when you deposit money in the bank, it must hold a portion and require reserves, and then loans the rest out. The person who took out the loan spends that money, and eventually that money gets its way back into another bank. So that bank then holds a portion and reserves and loan the rest out. This keeps happening over and over again. So yung cycle niya is ulit-ulit lang. Magdi-deposit ka ng pera, then dun sa dineposit mo, may percent doon na sa bangko mapupunta at yung another portion na natitira, yun yung mapupunta sa mga commercial banks. The effect of money multiplier can be seen on commercial banks. Ang mga bangkong ito ay tumatanggap ng pera or yung tinatawag natin na deposits. The money or the amount of money that is reserved by these commercial banks ay ginagamit in case na umatras ang depositors or kunin niya lahat ng money neto na nakadeposits. So, tinatawag natin yun na reserve ratio. As I was saying, the portion of money that banks have to hold by law is called a reserve requirement. So, the equation for this is money multiplier is equal to 1 over LRR or 1 over R, where LRR is the legal reserve ratio and the 1 is the minimum ratio of deposits that is legally required to be kept by commercial banks. So, if banks have to hold 10% or 0.1, then the money multiplier must be 10. So, the initial money supply of $2 billion becomes a total increase of $20 billion in the economy. So, yung mangyayari doon is yung $2 billion natin, ita-times natin siya dun sa money multiplier natin which is 10. Then, the result of this is yung $20 billion. So, another example, assume that reserve requirements is 0.2 and the Fed initially increases the money supply by 2 billion. So the questions are, how much is the multiplier and how much money supply increases? Here is the computation. Multiplier is equal to 1 divided by 0.2, which is the legal reserve ratio. Both are multiplied by 10, so that equals to 10 divided by 2. 10 divided by 2 is equal to 5. So yung multiplier natin is equal to 5. So the 2 billion increases money supply become 10 billion total. Lastly, the types of legal reserve ratios. If customers deposits money to the bank, not all money goes to that specific bank. Some are given to the reserve banks. So, yung portion of money na dapat na i-reserve is based on the cash reserve ratio. Cash reserve ratio or CRR is a type of ratio which refers to the minimum percentage of a commercial bank's total deposits which they are required to keep with the central bank. Next, in terms of the amount should be invested in liquid assets, dun papasok si statutory liquid asset or liquidity ratio or yung tinatawag na SLR. This refers to the minimum percentage of the net total demand and the time liabilities which are required to be maintained by the commercial banks. If SLR is 20%, then 20% is the amount which bank has to be invested in liquid assets at yung mga natitira is pwede niyang gamitin sa mga other expenses ng bangko. So, kapag naman nag-ask si customer na i-withdraw lahat ng pera niya at walang budget si bangko, ibebenta niya yung mga kanyang liquid assets kay central banks para maibalik or maisole yung mga pera ni depositors. That's the reason why banks can sell bonds to central banks dahil may mga instances or situations na nauubusan ng supply ng pera ang isang bangko dahil nga nakalabas ang mga ito.
Now that we know how money is defined, we'll learn how banks can affect the supply of money through fractional reserve banking. Let's imagine that you graduate from college and your grandma gives you $1,000 in cash that she's been saving under her mattress since the 1970s. And you deposit this cash in your checking account. What does the bank do with your money? Does it sit in a vault with your name on it? No! Banks lend most of your money to people who want to borrow. Banks keep in reserve only a fraction of your money. Money be keeping cash for the ATM or to meet withdrawal demand. This is why this system is known as fractional reserve banking. So what fraction of your deposit do banks keep in reserve? Well, large banks in the United States must keep in reserve at least $1 for every $10 in deposit. Or we say large banks are required to have a reserve ratio of at least 10%. But banks often have higher reserve ratios, depending upon how liquid that they want to be. If a bank is worried that its customers might withdraw most of their money, or if a bank loans are just not that profitable, banks will hold more reserves. So the reserve ratio can be greater than 10%. And it can change over time. Because of fractional reserve banking, the banking system has a big effect on the supply of money. Let's see how. Suppose that your bank keeps 10% of your $1,000 deposit or $100 as reserve, and suppose it lends out 90% or $900 say to Tyler, who's interested in starting a business. That $900 loan is credited to Tyler's checking account. So now, there's $1,900 in new deposits. And since checkable deposits are part of the money supply has increased. And it doesn't stop there. Suppose that the bank holds 10% of Tyler's deposit in reserve and it lends out 90% or $810 say to Janet. Now deposits have increased by $2,710 and suppose that 10% of Janet's money is held in reserve and the rest is lent out. And so this process continues. And as the banks make more loans, that increases the number of deposits, which increases the number of loans, which increases the number of deposits. So how much money do we ultimately end up with? You can figure that out using what's called the money multiplier. The money multiplier tells us how many dollars worth of deposits are created with each additional dollar of reserves. And the money multiplier is simple. It's just 1 divided by the reserve ratio. So if the reserve ratio is 10%, the money multiplier is 1 divided by 0.1 or 10. And what that means is that $1 in new reserves will ultimately lead through the multiplier process to $10 in additional money, as measured by say M1 or M2. Now let's clarify our previous example and why it was key that Grandma was pulling cash from under her mattress. If Grandma had instead given you a check for $1,000, she'd simply be transferring money from her account to yours, which would not be creating new reserves. And so we wouldn't see this multiplier effect. And naturally, the key player here isn't Grandma. It's Uncle Sam. The Federal Reserve can, with the click of a computer button, create new money which it can use to buy financial assets, thus injecting new reserves into the banking system. But the Fed's control over the money supply process is indirect. If banks hold the minimum amount of required reserves, 10% as we assumed earlier, then the money multiplier will be close to 10. And if this is the case, the Fed will have a lot of leverage to move M1 and M2 with a small change in reserves. But in normal circumstances, the actual money multiplier is closer to 3. How come? Well, remember, banks can hold less than 10% in reserve. They can always hold more, and the more banks hold in reserve, the lower the money multiplier. So it's important to understand that the money multiplier isn't a fixed number, and the multiplier process isn't a mechanical relation. Here's another factor. If Tyler had stashed some of his loan under his mattress, instead of depositing it into a bank, then this bank, it wouldn't have had the money to lend out his deposit. And the money multiplier would have been lower, and during a recession, both of these things can happen at the same time. Banks may be reluctant to lend and they'll maybe put more cash in reserve. Plus, people tend to hold more cash and not deposit their money in banks during a recession. Both of these factors cause the money multiplier to fall. So the Federal Reserve may have to push harder to increase the money supply during a recession than during a boom.
Today, we're gonna discuss the effects of interest rate to money supply. A fall in interest rate increases the amount of money people wish to hold, while a rise in interest rates decreases that amount. A change in prices in another way to make the money supply equal the amount demanded. When people hold more nominal dollars than they want, they spend them faster, causing prices to rise. Facts about money interest rate. A fixed interest rate is a key piece of a nation's monetary policy. The goal is to reach the equilibrium point where individuals and businesses are willing to borrow money from banks offering a set interest rate. Setting the fixed rate too high may reduce demand for bank loans since consumers are willing to pay a large interest amount on loans. Conversely, low fixed interest rates decreases a bank's opportunity for generating capital from loans to consumer. While the features are, nations may choose different fixed interest rates for short and long-term loans. Offering different interest rate can increase the loan products offered by banks in the economic marketplace. For example, nations can set high fixed interest rate on short-term loans because banks are unable to generate sufficient interest on these loans. Consumers may pay these higher rates if they have an intense need for immediate capital funding. Even though the loan will cost more money, lower fixed interest rates on long-term loans can increase money demand for capital, investment, or major purchases. The example questions are, how does lowering interest rate increases money supply? Second is, What happens to the interest rate if the money supply increases or decreases and the money demand remains unchanged? Third is, does interest rate affect supply or demand? And fourth, what is the relationship between interest rate and demand for money? Here are the top 12 factors that determine interest rate. First is credit score. Second, credit history. Third, employment type and income. Fourth, loan size. Fifth, loan-to-loan value or LTV. 6, loan type. 7, length of term. 8, payment frequency. 9, property type. 10, co-borrowers. 11, debt ratio. And 12, documentation available.
Effect of central banks' money operations in money supply. But first, let's tackle the central bank. Reserve Bank or monetary authority is an institution that manages the currency and the monetary policy of a state or formal monetary union and oversees their commercial banking system. Central bank, in contrast to a commercial bank, a central bank possesses a monopoly on increasing the monetary base. How does central bank operate? Central banks carry out a nation's monetary policy and control its money supply, often mandated with maintaining low inflation and steady gross domestic product or GDP growth. On a micro basis, central banks influence interest rates and participate in open market operations to control the cost of borrowing and lending throughout an economy. The other reporter, they explained the money supply, but I will say it again that money supply is the total amount of money, cash, coins, and balances in bank accounts in circulation. Ang sample nito ay US currency and balances held in checking accounts and saving accounts are included in many measures of the money supply. So, the effect of central banks' money operations in money supply, central banks affects the quantity of money in circulation by buying or selling government securities through the process known as open market operations or OMO. When a central bank is looking to increase the quantity of money in circulation, it purchases government securities from commercial banks and institutions. How does banking affect money supply? So, ito yung explanation. Every time a dollar is deposited into a bank account, a bank's total reserve increases. The bank will keep some of its on hand as required reserve, but it will loan the excess reserve out. When that loan is made, it increases the money supply. This is how banks create money and increases the money supply.
Hi, I'm Jonathan C. Aguas and my report is about the effects of increasing or decreasing reserves in money supply. Reserve requirements are tools used by the central bank to increase or decrease the money supply in the economy and influence interest rates. These are amount of funds that the bank holds in reserve to ensure that it is able to meet liabilities in case of sudden withdrawal. They keep a certain amount of deposits on hand to cover possible withdrawals. This amount is called the reserve requirement, and it is the rate that banks must keep in reserve and are not allowed to lend. By reducing the reserve requirement, the Federal Reserve System is executing an expansionary monetary policy, and conversely, when it raises the reserve requirement, it's exercising a contractionary monetary policy. This latter action cuts liquidity and causes a cooldown in the economy. Expansionary monetary policy increases demand and supply in an economy. The increase in demand and supply is mirrored by an equal increase in nominal output or the GDP or gross domestic product. In addition, the increase in demand and supply will lead to an increase in consumer spending. It is used to increase economic growth and generally decreases unemployment and increases inflation. It attempts to promote aggregate demand growth. Aggregate demand growth is the sum of private consumption, investment, government spending, and imports. Contractionary monetary policy decreases a nation's money supply to curb rampant inflation and keep the economy in balance. A central bank will likely hike interest rates and try to slow the growth of money and prices. All banks are required to have a certain amount of cash on hand to cover withdrawals and other liquidity demands. By decreasing the reserve requirement, more money is made available to the economy at large.